People believe that the last time we saw a setup like this, everyday people became millionaires. And it's true, but not for the reason that you and everybody else may think. It's not because they were able to find one stock that went crazy from all-time highs. No, it's the people who followed a simple plan. They stuck to it. And today, the same signals are flashing. And in this video, I'm going to show you what's really happening, why it matters, and how you can take advantage to be one of the few people who truly takes advantage of what's going to happen in the market over the next few years. We are in the middle of one of the biggest and best bull runs ever. AI stocks are flying, markets hitting new all-time highs. You can feel the excitement. You go online, every video says some new tech is going to change everything. Life is going to be different. Your friends are talking about how easy it is to make money. Stocks only go up. And when they do fall, the market recovers very quick. Remember in COVID, we had a 1 month fall. Yeah, it was 40%, but it was right back before the end of the year. But guys, this thing is too familiar. Back in 1999 and 2000, we saw the exact same thing. Everyone, and I mean everyone, was convinced the internet was going to change the world. And guess what? They were absolutely right. But people took that story and forgot the most important investing rule. Price matters. This is what differentiates investors from speculators. Speculators, even though they might say price matters, they're buying everything at any price. Investors say, at what price? I feel the same thing is happening today. AI is going to change the world. Absolutely. But price doesn't seem to matter to a lot of people. And that should give you pause. I remember back in 2002, my dad took me to one of his friend's house for a barbecue. His friend was a doctor. We were talking about things, and I said to him, like, hey, how is he? He's like talking about the heyday of stocks. I go, well, how's it going now? He goes, oh, my account's like 50,000. I'm like, well, what were they worth at the peak? He goes, about 5 million. And I was like dumbfounded. First off, I loved how open he was with me about this. Most people who lost 99% of the money would have been like losing their mind and embarrassed. He was just like, it was like 5 million. Now I'm like, was it at 50,000? Let that sink in, guys. You don't recover from that, but this is what happens in bubbles. Prices go crazy, people get rich, then it crashes. When the dot-com bubble popped, the NASDAQ fell over 80%. And guys, the NASDAQ has companies that are very legitimate companies. These are not the fly-by-night internet companies that we're talking about. These are legitimate businesses with legitimate revenue and cash flow. They went down 80, 90%. Now, they were dragged down with all the garbage companies that had a .com in their name that had no revenue and went to zero. But that's the point. When the garbage falls, it'll drag down the good stuff with it. Millionaires on paper went to nothing overnight. I actually had a personal friend of mine whose father had to declare bankruptcy because of too much of a bet on tech. And here's what I want you to understand. Bubbles never end with a gentle landing. They crash. They crash hard. But not everything dies. Companies with real businesses, actual profits, strong balance sheets, competitive advantages, they fell, but they survived. And they came back stronger. Microsoft fell from over $50 a share down to $11 or $12 a share in 2010 or 2011, even though its earnings per share were up 2 or 3 times. So here was a stock that was plummeting while profit was going up. That's what you want, guys. But guess what? The story I always tell, 2012, I was buying Microsoft. I was meeting with a friend of mine who was a big shot tech CEO, and I mentioned Microsoft, and he said, oh, that company's dead. I'm like, well, I mean, you'd still buy it, though, at the right price. He's like, no, that company's absolutely dead. I'm like, well, no, if you could pay $50 billion for it and it had no debt and $100 billion in the bank, you'd buy it. No, Paul, you don't get it. That company is dead. And I was just like, oh, my God. This company is generating revenue growth of 7 to 9% a year and profit growth of 10 to 12% a year, and he says they're dead? This guy is paying too much attention to the story and not reality. But Microsoft, that's why it survived. That's why it came back stronger than ever. And I guarantee that same tech guy, if I were still in touch with them, would say he never said that about Microsoft, and Microsoft's one of the best companies out there. There were 2 types of investors from that area. Investor 1 was the ETF buyer. So let's say you believed in America and understood that time in the market beat timing in the market. You were able to be smart enough to buy the QQQ, which is a NASDAQ ETF, at the absolute top. So literally March of 2000, you're like, I'm gonna start buying. Worst timing imaginable. But if you kept investing, month after month, year after year, watched your stock go down over 80% in the next 2 years. Guess what? From then until now, you'd have made over 14.5% return per year, even starting out with an 80% crash. You ignored the stock picks from the tab drivers and all the .com hypesters. You'd be a multimillionaire today if you just invested well. Now, investor 2. I won't even call them investor 2. speculator, the hype chaser. This is the other group. The ones who chased the hot stocks. Guess what? I was part of them. They heard about the next .com stock. They heard about the next company that was going to change the world. They bought it because their cousins, boyfriends, husbands, former dog's first owner said it's going to the moon. A lot of those stocks are gone. They went bankrupt. They were worthless. Guys, I bought Global Crossing because my sister's boyfriend's father said they were changing the world because they're putting fiber lines across oceans. They was the fastest CEO ever to $1 billion, did it under 11 months. The stock went to zero. Even Amazon, which by the way, I said was overpriced back then, dropped 95% between 2000 and 2002. If you put $10,000 in Amazon, you were down to $500. You'd have to be a machine, to be a robot, not to panic and sell. And the worst part, a lot of people sold at the bottom. They said, this is rigged. So it's interesting to me. It's rigged when it falls. It's not rigged when it goes up. The difference, one person followed a process of those two. The other person followed hype. Now, you might say, well, Paul, wasn't it 9/11 that caused the crash? I've heard this before. No. The bubble started to pop in March of 2000. 9/11 wasn't until September of 2001. By then, the NASDAQ had already fallen, I think 60 or 70% at that point. The crash didn't need a trigger. It popped because finally valuations mattered, and they mattered with a vengeance. When investors finally stop having some sort of buyer to come in, prices start to collapse. Now, company I talk about all the time that I love discussing, Cisco. Cisco was the NVIDIA of 2000. It was going to be the first $1 trillion company. Huge growth, huge expectations. It peaked at $82 a share back on March 27th of 2000. Pretty much in line with the peak of the 2000 tech bubble. Today, it's actually lower than that. Now, you might be wondering, well, Paul, let's look at the profit here. Well, let's go look at the profit here. Let's go pull up our trusty income statement. Back in 1999, Cisco did $12.2 billion in revenue, and they did $2 billion in profit. Today, they do $56 billion in revenue, over 4 times more, and they do $10 billion into profit, 5 times more. So if I told you back here that Cisco, 25 years later, would have 4x revenue and 5x profit, would you think the stock would be down? No, of course not. You'd be like, oh my God, this thing is going even crazier. But the problem was it was so massively overpriced. And guys, guess what? It's not like it's a screaming deal right now. In fact, in our community, the average rating is a hold, and it has a PE of 28, and a price of free cash flow of 21. It's not exactly cheap. Guys, think about that again. 5 times more profit, 4 times more revenue, and it's still below the 2000 price and isn't still selling for some super cheap valuation. Why? Because people overpaid. That is the danger of hype. Even great businesses can be terrible investments if you pay the wrong price. Now, what's interesting is this. Before this hype train started, if you go to right there and today, you take out this little part right here. Doesn't look so bad, does it? It doesn't. And guess what? From here to here, the stock is up 10x. What would you guess the profit and free cash flow are up? In the short run, stocks are a voting machine. In the long run, they're a weighing machine. If you pay a reasonable price today and profit goes up 10x, you're probably going to see a 10x increase in your price. It is that simple. And in hindsight, it's easy to sit there and say you could do that. But along the way, you have to put up with that, which is a lot bigger drop than you think. How much of a drop is that? Let me tell you. The peak here was $30. The low here was 17, almost a 50% drop. Oh, then you saw a rebound and then a fall even further to $15 per share. So even from here to here was another 50% drop. You'd have been like, oh my God, this thing won't make any money. But if you understood the fundamentals, if you understood how to understand a company, you'd say, yeah, but here to here, revenue's up, profit's up. I'm good. The market will eventually figure it out. That is not easy to do. But the more you watch these videos, the more you repeat these things, they will become ingrained in your brain like they did for me. Now, guys, if you saw the title to our video, you probably sit there and think something along the lines of bull markets make millionaires. I disagree. That's like telling me that becoming a professional baseball player makes you a millionaire. No, the effing work you did ahead of time The grueling workouts, the working on your craft to get to the Major League Baseball level, that's what made you a millionaire. Same thing here. The stock market going up is the result of you preparing the right way and having the right mindset along the way. That's what you're going to learn from things like this and things like this. But it's harder to learn on the way up. Nothing is worse than being right for the wrong reasons. Because I guarantee the person at this point was bragging because they bought right here when they overpaid right there. In fact, if you go across right here, they only hit that price one time until the late teens, 20 some years. And they would have thought they were right because of this. And I see it all the time. Go look at Palantir right now. People say it to me all the time. I didn't buy it at $5. It was at $5.83. I said my buy price was $5. I never bought it. It's at $200 now. And people are saying, oh, he missed out on that. Okay, no sweat. I'm not worried about that because I feel like Palantir is somewhere along here. I don't know where, but it might be here. And if it's not, more power to anybody who bought it for the right reasons and makes a killing. But if you bought it for the wrong reasons and you made a killing, use that as a learning lesson. But it's hard to do that. Guys, this is why I teach on YouTube, because you're not going to hear that from out there. I get messages on Instagram and Twitter all the time, people saying, Paul, you changed the way, and because of you, I'm up blah, blah, blah percent. I write back, it's not because of me. It's too short notice to be able to determine that. I want to wake up 10 years from now and somebody look at me and say, Paul, we had 2 bad bear markets and I was calm. I went and bought more. That's because of me. That's the thing I want people to take away. That's why I teach on YouTube. I'm not here to hand out stock picks. I'm here to look at companies, make determinations based on what I feel, and then tell you, go think that way about other companies. So, a couple of lessons I want you guys to learn. First off, if you take nothing else away from this video, this is what I want you to take. That NASDAQ 100 dollar cost average example. Stay invested. Dollar cost average into low cost ETFs. Don't try to time the market. Every time the world feels like it's falling apart, which will happen, I want you to remember that things will always get better. And if they don't get better and the world does fall apart and we go to nothing, you might as well dollar cost average because your money's gonna be worth nothing anyhow. You might as well get it invested. Because if you're wrong and the world does wake up and all of a sudden everything's normal again, you would have missed out on tons of gains by selling. SPY, VOO, they just follow the S&P. You're buying 500 of the biggest companies in the world month after month, rain or shine. Over time, that's how you win. Number 2, stop chasing the next big thing. Don't chase Palantir because it's up. Don't chase Tesla because it's up. Don't chase Nvidia because it's up. If you don't understand the business, you don't know how it's going to make money, you're not going to know how it's going to lose money. You're not investing, you're guessing. I said about Palantir. At $40 to $45 a share, people out there were saying it was going to 500. I said I was interested at 5. Paul, you're crazy. It went to 583. I'm not saying I was right for that reason. I'm just saying I knew it was worth a lot less. It just happened to go down 580 to 583. And guess what? It went soaring back to $200 per share. But guess what else? How many of the people who bought at 45 stuck with it down to 5? I guarantee it was very few, if anybody. And now people are saying, look, we were right. I still have Palantir worth a lot less than it is today. And I've shown the numbers even on aggressive assumptions to say, I don't think it's worth more than $20 or $30 a share on the high side. But if being right just means that in the short run prices went up, then you were also wrong when it went down. And that's what people don't remember. You're not wrong on Palantir because it went from 45 to 5. You're wrong because the reason you justified 45 was incorrect. That's something very important to understand that I 100% guarantee you no big channel on YouTube talks about. Now, very important quote that Philip Fisher has about the market. The stock market is made up of individuals who know the price of everything and the value of nothing. Price is what you pay, value is what you get. So let's say Palantir trading at 448 times earnings. That's a PE of 448. Price to sales ratio of 126. Keep in mind, Microsoft, an expensive company, is selling for 13 times sales. This is 126 times sales, 10 times more. Is it cheap or is it expensive? Well, guys, just on those numbers, I would say if you blocked out as Palantir, I'd say, I don't know. Can they double their profit every year for the next 30 years? That's the question to ask. Now, obviously, I know it's Palantir, and I've run the numbers on them saying, yeah, it seems pretty expensive. But if you don't know how to answer that question, that's your signal. It's time to learn how valuation works. Because when you understand value, you drastically decrease the amount of emotional decisions and reactions you make. You greatly decrease guessing. Guys, the future is unknown. We have to do some sort of speculation about the future. But now you'll have a process, and you'll start buying with confidence. So let's pause and talk about the most underrated thing to talk about in investing. Emotions, because this is exactly where most people lose. There have been countless studies showing that people don't match the market because they buy at the wrong time and they sell at the wrong time. Peter Lynch was a fund manager from 1978 to 1990. He made 28% a year or something. And you know what he said? He's like, 90% of my investors didn't make anywhere close to that because they bought after my fund had run up in price. You look at ARK Investments with Cathie Wood, and it still boggles my mind how Cathie Wood can be taken seriously. Her ETF is up so much since it started, yet the average investor is down significantly been buying. Why? Because they bought when the time was wrong, because when the price was going up like crazy. Everybody made fun of us when we were saying Cathie Wood didn't know what she was doing in early 2021. And then her fund went from $160 a share down to $30. I don't even think it's worth $30 a share, to be honest with you. She's always jumping in and out of investments. Worst thing to do. She sold NVIDIA right before the big run up. By the way, I'm not saying that it's a criticism, but I'm saying it as looking at her going, so the stock fell, so you sold it? Are you kidding? How about understanding the value? But yet she's an expert on Bitcoin. Why? Bitcoiners love her because it's this echo chamber, as a circle jerk of, it should be worth $1.5 million a coin. Based on what? Well, it's limited supply. Well, guys, I can take a dump in a garbage bag, put it in the middle of the street. There's only one of those in the world. Is that worth unlimited? It has to have use in order to have value. That's why gold has value. There is use for gold. But most people have a fear of missing out at the top. Guys, it's not about intelligence. It's about emotion. It's about behavior. Study after study shows what I said before. The average investor earns less than the market, even when they're invested in low-cost ETFs. They make bad decisions. They pull out when things feel scary. They jump in when things feel safe, when it's usually too late. That's why you need principles. That's why you need a process, because process protects you from yourself. Now, when I'm buying an individual company, I ask 3 simple questions. And like I said before, I keep things as simple as possible. 1, do I think this company will be around for the foreseeable future, 10, 20, 30 years from now? If the answer to that is yes, I go to the next question. Will it have more revenue or less revenue, and more profit or less profit 20, 30 years from now than today? If the answer to both those is yes, is higher revenue and higher profit, I go to the third one. And the most important one, can I pay a reasonable price today that gives me an adequate return on the money that I have invested? If the answer to all 3 is yes, I have to look deeper. If not, I move on. But that third question is the most important one. That's the price versus value question. And here's what I love about investing. You don't need a finance degree to crush it. In fact, the pros often do worse than even you do. Why? They have career risk. They have to match benchmarks. They have to play it safe. They have to worry about what everybody else is doing. You don't have to do that. You can focus on what matters. That gives you the edge. You're only investing for yourself. And this is exactly why I teach here, to show you that everyday investors can win, not by being smarter up here, by being smarter in here. Being more patient, more principled, more focused. Now back to Palantir for a minute. Let's say Palantir somehow doubles its free cash flow every year for the next 10 years. That would make it worth hundreds of trillions of dollars. But what if the growth slows? What if margins shrink? Suddenly you've overpaid. The investment breaks down. Even if the business does well, that's the lesson. You don't just need a good company. You need the right price. And guess what? Usually when you finally find the right price, it goes down even further. Do you have the ability to say, okay, let me buy some more because my fundamentals probably have not changed? So guys, when the market's flying and everybody's making money, it's easy to get caught up in the hype and to have FOMO. But this is where most people make big mistakes. They chase the hot names. They buy what's going up and they don't stop to ask the most important question. Am I paying too much? I have made every possible investing mistake you can imagine. I bought too high, I sold too early, I listened to the wrong people, and that's exactly why I built Everything Money. It was first built purely for me. I wanted the tools that gave me clarity and decreased the fear of investing. People saw me using these tools on YouTube and said, Paul, can you share those? And at first I said, no, it's a data feed. But then I realized, I could make this. So I did, and the real community was born. Real people sharing ideas, live chats, live streams, and tools that help you beat 99% of investors, but most importantly, help you sleep better at night because money can be very scary. I still use these tools every single day, like Stock Analyzer, Real Estate Calculator. So stop guessing, start learning, start sleeping better. Try it for $7 for 7 days. I'll see you in there. Now, If I don't have a great stock at a great price, no problem. I'm still going to keep on dollar cost averaging in my low cost ETFs. These ETFs are the basket of companies like SPY and VOO that has 500 companies in them. It gives me exposure to the biggest, most profitable businesses in the world. And guess what? It gives me exposure to the US economy. And if the market drops, I'm buying those same great businesses at cheaper prices. That is how you build wealth. You buy great companies at great prices over time. It's not flashy, but it works. And if I'm picking individual stocks, I'm buying when price is below the intrinsic value. It's simple, buy great businesses at great prices, but it's not easy. Doing that takes this. Doing that takes also understanding how to value the companies. These are the setups that make people wealthy over a 30 or 40 year period. Now here at Everything Money, we don't chase hype. We don't have FOMO. We don't want you chasing a hot stock, hoping to get rich tomorrow, and in the end, probably overpaying. We want you to get rich as fuck over the next 20, 30, or 40 years. But we want it because you followed the right principle and you followed a principle-driven investing process. We have the principles and the process, and we stick to it. No matter what the market's doing and no matter what stock is having a big run, we live by 5 simple but powerful tenets of principle-driven investing. First off, we are investors, not speculators. Second, every investment is the present value of all future cash flows. Third, if we don't understand it, we don't buy it. Fourth, in the short run, stock market is a voting machine. In the long run, it's a weighing machine. The fifth and most important one, a great story can become a bad investment if you pay the wrong price. Those tenets keep us focused. They help us block out all the noise out there that the market's going to make. And the good news for you guys is I don't expect you to memorize these. I created a free PDF that explains all 5 thoroughly so you can have it readily available. So click the link in the description and download it. It's a simple shortcut. It'll change how you think about investing forever. This PDF is part of your 3-foot shots like Steph Curry. Do what I do. Read it regularly. So if you want to see how I apply all of this to real stocks, check out the video on your screen right now. Early this year, I picked 7 stocks to go head-to-head with Magnificent 7. The results? You'll be surprised. Click it now. I'll see you there. Thank you for your time.